I don't think it's just normal market behavior. It's anything but. It's desperation manifesting itself in a drive-by shooting to create a perception of reality for whatever reason to throw people off the scent. It's misdirection at its greatest level. And it's the same thing we've seen all along. And if you've been doing this as long as I have, a $250 drop in gold, yeah, it makes you want to puke, but it doesn't get you scared. It tells you you're getting closer to the point where the physical demand overwhelms the ability of these paper charades, these paper drubbings that we haven't seen for quite some time, to be honest with you. But here it is again, and this one really reeks of desperation, as you can see by it happening one in only 240,000 days in a normal market.
Usual volatility in precious metals reflect structural market dynamics rather than fear. Paper markets can create artificial sell-offs that exaggerate supply, while physical metals remain limited. Experienced investors interpret these movements as buying opportunities, since scarcity in the physical market ultimately drives long-term value.
Michael Lynch says Barclays sold 1,969 contracts, RBC customers 1,076, and Scotia House account 2,024. And, could it be profit taking from earlier buys? Maybe. But at 100 ounces a piece, when you're talking 2, 3, 5,000, 6,000 contracts, that's an awful lot of gold being dumped. We don't know who and why they would do it specifically, but he is saying it's the banks that are not the U.S. banks. Barclays, RBC, and Scotia are the ones that he points to, and he has all sorts of empirical data.
He has the evidence.
Yeah, you can go and take a look at his Substack. He publishes what he believes is the data and the footprints, the fingerprints to who sold. And I don't think it's just them. But again, it's like pushing a rock down a hill. And once it starts to move, it starts to, like a rolling stone, it starts, or a snowball starts to get bigger and bigger and bigger. It's getting bigger because it's triggering stops along the way. There are a lot of people that sold into this rally who would have probably hoped into this drubbing, that probably hoped they never would have had to have those stops triggered. But I think that's what happened in the middle of the night when you saw such a massive drop at a period of time when there was no liquidity, which just dropped the price. And then all of the triggers that would then automatically hit to sell to protect these funds from getting killed would only add to the drop. And then you had the value buyers come in and push it right back up. That's too coordinated to be coincidental, and too stupid to be stupid.
Paper markets hold billions of ounces in contracts while physical supply is limited, creating extreme leverage. Coordinated selling followed by strategic buying allows major players to acquire metals at suppressed prices. Stop-loss triggers and low liquidity amplify price swings, but they do not reflect the underlying scarcity of physical gold and silver.
And again, I will, zoom out to, again, the bigger picture here, which of course is still very, very, very bullish for gold despite any kind of manipulation. But it does bring up the question, Andy, if gold and silver can be so relatively easily manipulated by the paper market, why is it a good investment? Like, why shouldn't that deter people?
There are no free markets anymore, Michelle, just manipulations. But you can see the movement of these assets, these commodities, largely moving to the global south and east. And the exchanges that are popping up in places like Singapore, Shanghai, Dubai, Moscow, St. Petersburg, the BRICS facility that they're building, these will be the price-setting mechanisms that will take over for the LBMA and the COMEX. Maybe not the COMEX if President Trump has something in store. Hopefully he does. But I would argue that the Western system of pricing commodities is coming to an end. And certainly those that are rehypothecated the way that they are, you look at those exchanges across the globe, they're largely cash and carry, pay, receive. The ability to, and I'll bring you back to 2020 in the middle of the pandemic, oil went to negative 40 a barrel. Now, how the hell does that happen? How does oil go to negative 40 a barrel? We'll pay you to take the oil. Well, the point of it is that when the futures market is the tail wagging the dog, setting the price for the underlying commodity, you have a problem. It should be the commodity that sets the price for the futures, not the other way around. And I think the world is growing tired of the way that the West has been able to control the commodity complex for all of these years. And that's why I've always talked about the fact that the challengers in the BRICS nations, and you look at who are the ones buying all the gold and silver. Well, it's China, it's India, it's Saudi Arabia, it's Russia, and we know this. We don't know exactly how much they're buying because wasn't it Saudi Arabia and China that both got flagged by the IMF for not reporting what they were bringing in? And we see China buying doré and concentrate, which would not meet the 999 requirement that the IMF would need for reporting. These countries are doing everything they can to play the game along with the West, suppress the paper price, stand for delivery on cheaper stuff. They're playing the same game that we are, only against us. They're coordinated and they're motivated. And that's why there is such a low float in London, which I've been screaming about for years as it's been drawn down against a massive long position, 2 billion ounces, David Jensen, of deliverable contracts against 140 million ounces available.
Alternative commodity exchanges in Asia and the Middle East operate on cash and carry physical settlement, reducing reliance on Western paper markets. Strategic accumulation by China, India, Russia, and Saudi Arabia strengthens their control over real assets, shifting the balance of global pricing power and challenging the dominance of traditional Western exchanges.
We make America great again, and ultimately even in a way save the dollar by weakening the dollar. And I know you have some theories there about how that fits in with potential secret plans of the US government trying to shore things up with gold.
That's what we've been saying all along. This is the debasement trade. This is the Mar-a-Lago Accord, devalue the dollar. You know, Vince Lancy, I was listening to his morning podcast, and he said, you know, debasing the dollar before manufacturing is built doesn't really do anything except help us with the deficit. It hurts the economy, and you have to have the manufacturing here before you debase the dollar. Maybe that's started to get ahead of itself. You look at gold, which, you know, you can go back and look at how many ounces or how many hours a person has to work to buy an ounce of gold, and it's at its highest level ever. It's doubled in the last 18 months, and meaning gold is outpacing everything. It's outpacing the rise in wages. It's moving too fast. It's catching too much attention. And when you hear reports in the mainstream that foreign investors now hold higher amounts of gold than U.S. treasuries, and you know that it's down to 31% from 49% a decade ago, yeah, I think it certainly maybe is moving a little too far, too fast, or at least catching too much attention at an inopportune time for the U.S., who is trying to do something. But ultimately, I think higher gold is what they want, not to make gold higher, but to continue to debase the dollar. I do believe that. I just think that there's a lot of moving parts at hand that could accelerate things too quickly with the fragility of the system, in particular the fragility of the banking system. And maybe it's just gotten a little ahead of itself in terms of what their plan is.
Rising gold prices indicate declining confidence in the US dollar as the global reserve currency. Strategic accumulation of gold by the US could support treasury stability while allowing controlled dollar devaluation. Physical gold functions as a hedge against systemic risk and provides a foundation for restoring credibility in monetary and financial systems.